Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Again, no holy grail here. A lot of thinking here. Understand currency prices really reflect what we do know in the world. They discount powerfully things that we do know. All right? So this idea of trying to forecast future events is sometimes not the best thing. Understand what the expectations are and then see how real-world events play out against expectations to determine how much surprise there is. Number two, understand the interest rate, inflation rate backdrop. It's really a great thing to understand because first you understand that, then you understand how the consensus sees that. You're very alert to what's going on in the world in terms of the most powerful driver for currencies, i.e. interest rates. And if you use those interest rate rules on top of this, I think it'll put you ahead of the game trading on an intermediate to long-term basis in the currency markets. Don't try to forecast interest rates, as I said, just see how reality plays out against what people expect. Do the best to determine the prevailing trend. That's pretty easy in terms of charts, long-term charts, daily, weekly, again, whatever you use, trying to determine the prevailing trend to see if it's moving in line with the current sentiment. You're looking for those setup conditions. Ultimately, again, the goal is this idea of setup conditions. When we see major extremes in sentiment, it usually means we're near a turning point. We're getting fairly close, I think, on the dollar, but who knows, we could go a little further. Maybe we haven't reached those types of major turning point extremes, but we're seeing some very negative sentiment on the dollar, and it's been holding up fairly well on a relative basis. I think once you get a handle on this stuff, it will tend to improve your confidence, and ultimately we want to make trades that we have some confidence of this reality background that we can understand, that we can see, as opposed to guessing what the ECB is going to do in 6 months or determining what France is going to say in terms of cracking down on pensions 2 weeks from now. That stuff, we can make all kinds of noises about this and sound smart trying to predict that, but even if we get it right, we don't necessarily know what the currency is going to do. So we want to try and really get under a feel of really sentiment and how sentiment views this whole interest rate, inflation, and trend backdrop in currencies. So sum it up. Ultimately, if you're trading, you need to know your risk. You need to know your reasons, and your reasons are really this stuff here we just talked about. This stuff happens in all types of time frames, but the type of time frames that I think this can be best utilized is the intermediate term, and I'm talking from 3 months to 6 months type of time frame. I think ultimately those time frames are really where the meat is in currencies if you get it right. U.S. dollar here. At the moment, as I talked about, here's a U.S. dollar index chart going back to 2000, showing the peak here, 2001, 2002, double top in there, and then we've been in a pretty massive bear market all the way down to March of 2008 where the U.S. dollar bottomed, had a significant bounce and a pullback in here, and again, this is what markets do. Even if this is a multi-year bear market, guess what? It just shook out a whole lot of multi-year bull market move in the dollar. This pullback after it hit 90 has shaken out a whole lot of people and turned sentiment very, very negative on the U.S. dollar. We have to say that if perception of the trend, that the trend is definitely down in the U.S. dollar. If we looked at the yield, inflation differentials. From a yield differential, short-term, U.S. is really in the tank. But if we look at the more value-based driver in terms of currencies, intermediate to longer term, the U.S. is in pretty good shape on the 10-year yield when we factor in the U.S. inflation differential. And often you'll see portfolio flows from that standpoint really a much more powerful driver than concerns on trade and things like that We've seen that over the years, so just be careful of this idea that the U.S. dollar has to go in the tank. When you see that type of value relationship in the 10-year yield, it's a pretty powerful proper support. One of the other reasons we've been thinking the U.S. is close to a bottom in here is the idea that we think we're close to a sentiment extreme. Could it get worse? Yeah, historically. It's a little tough to judge now in terms of the open interest that we're seeing in the Chicago Mercantile Exchange, because the trading in the currency futures has fallen off dramatically because the investment banks have gone away. So it's tough to make some of the historical representations we made before. But in general, the relative bull bearishness has been running from, if you add up all the major currencies, is running about 70% bearish, 30% bullish for the last several weeks. Could it get higher? Yeah, but we're in the territory in which an extreme may be reached in terms of negative sentiment on the dollar. And what we've noticed even in the last couple of weeks, and we've seen this in some of the jobs reports, is the good news has tended to help the dollar of late. Powerful bear markets, good news doesn't seem to help at all. And we're starting to see, as I talked about the change in correlations, we've even seen some days lately when the stock market's been up and the U.S. dollar has been up at the same time. So we're at a point now in which I think we got to be really careful about, constantly selling off the dollar. And I think the market is telling us that, obviously, because if you look at on a daily basis a chart of the currencies, we've been sideways for about almost the last 2 months in the currency markets. There's a lot of confusion out there in the fact that the dollar has gone sideways, or at least has held and not made a new bottom in a fairly negative sentiment extreme market when U.S. interest rates are so low. It's just another one of those just qualitative factors that you have to keep in mind. But again, the reality is the trend of the dollar on a daily basis is down. The trend of the dollar on a weekly basis is down. So if we do see something that changes these expectations in terms of interest rates, that surprises the consensus, in that if the Fed comes out and says, for example, we're not going to hike interest rates till 2013, that would be a fairly powerful negative driver for the U.S. dollar going forward. Same token, if we saw the European Central Bank come out and say, we're going to raise interest rates next week and we're going to raise by a full point, I think you would see the dollar get hit very, very hard, as the euro is kind of your major indicator for the dollar, meaning that it plays the mirror image of the dollar. So I guess the point is that you're constantly just evaluating these. I really think these factors, if you focus on these factors and kind of clear your head of all the other stuff out there, if you're the type of trader that isn't purely technical, I think this stuff really can help. Again, we could probably do a seminar on each one of these topics, and I don't know if I've covered it very well, because it's a tough area in which you don't really show an indicator and say A plus B did this. And this really is how markets work. It's this constant process of evaluating what the consensus is doing, understanding the trend, and just making a probability bet based on the combination of all this. That's the reality of what investing is about, especially in currencies, unfortunately, because there's so many different drivers. But I think that sums up fairly well where we are in the dollar. And let me go ahead and there's some information on Black Swan and what we offer. And we offer, obviously, a host of different newsletters and some managed money accounts that we just started. And if you can go to our website at blackswantrading.com and for more information. And if you want a copy of this webinar, obviously it'll be here at ISE. They'll have it posted for you. And I think in terms of what I presented today, I think those interest rate rules, if you get a copy of those interest rate rules, I think just keep them on your desk, in your drawer. If you're the type of trader that trades longer term in currencies, that can use the FX options trading, 3, 6, 9 month time frames on the FX options, I think they'll come in handy for you in terms of the interest rate rules. And let me pass it over to Elanette.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.